Is your tax refund feeling a little lonely? Like it could use a friend? Or maybe your partner's refund is looking a bit too robust, and yours is feeling, well, a little thin. If you've ever pondered whether filing your taxes jointly with your spouse or common law partner is the smarter move, or if going solo is the way to go, then you're in the right place. Because when it comes to taxes in Canada, it's not always as simple as together is better. In fact, unlike some other countries where joint filing is the norm, Canada has a unique approach to how couples file their taxes, and understanding this distinction can be the key to unlocking significant tax savings for your household. We're going to dive deep into the world of tax filing for couples in Canada, specifically through the lens of Wealthsimple Tax. We'll explore the nuances of individual tax returns, even when you're in a common law or married relationship, and uncover the strategies Wealthsimple uses to optimize your family's overall tax picture. Forget what you think you know about joint filing in the traditional sense, because in Canada, it's more about linked individual returns that work in harmony to maximize your benefits. So, grab a coffee, maybe even your partner, and let's unravel the mystery of filing jointly or individually with Wealthsimple, and discover how you can keep more of your hard-earned money in your pockets. First things first, let's address a common misconception. In Canada, married or common law couples do not file a single joint tax return. Each individual is still required to file their own separate tax return. This is a fundamental difference compared to, say, the United States. However, that doesn't mean your marital status has no bearing on your taxes. Far from it. Your marital status and your partner's income absolutely influence your eligibility for certain credits, benefits, and deductions. This is where the concept of linked or coupled returns comes into play, especially when you're using a smart tax software like Wealthsimple Tax. Think of it this way. While you each prepare your own individual tax return, Wealthsimple Tax acts as a financial maestro, orchestrating both your returns together. It looks at your combined financial picture and strategically allocates certain credits and deductions between you and your partner to achieve the best possible outcome for your household as a whole. This optimization is crucial, and it's where the real magic happens. So, if you're not actually filing jointly, why does everyone talk about it? It's because the impact is similar to what people imagine joint filing to be: shared benefits, maximized credits, and a lower overall tax burden for the couple. Wealthsimple Tax automates this process, making it seamless and ensuring you don't miss out on any opportunities to save. Let's break down the key areas where your coupled status and Wealthsimple's optimization can make a significant difference. 1. Income-tested benefits. The family unit matters. Many government benefits in Canada are based on adjusted family net income. This means the combined income of you and your spouse or common law partner. If your family income crosses certain thresholds, your eligibility for these benefits might change. Canada Child Benefit, CCB. This is a prime example. The CCB is a tax-free monthly payment made to eligible families to help them with the cost of raising children under 18 years of age. The amount you receive is directly tied to your adjusted family net income. If one partner has a significantly higher income, it could reduce the CCB amount for the family. Wealthsimple Tax helps accurately report both incomes to ensure you receive the correct amount. Gulf Standard Time/Hawaii Standard Time credit, similar to the CCB. The Goods and Services Tax/Harmonized Sales Tax credit is a tax-free quarterly payment that helps individuals and families with low to modest incomes offset the Gulf Standard Time/Hawaii Standard Time they pay. Your eligibility and the amount you receive are determined by your adjusted family net income. If you become married or common law, and your combined income increases, you might find your Gulf Standard Time/Hawaii Standard Time credit is reduced or you no longer qualify. Wealthsimple ensures your marital status is accurately reported to reflect this. While these benefits are calculated based on family income, remember, you still file individual returns. Wealthsimple Tax simply ensures that the necessary income information from both partners is considered for these calculations. 2. Transferable tax credits, the art of shifting savings. This is where linked returns truly shine and where Wealthsimple Tax earns its stripes. Canada allows for the transfer of certain tax credits between spouses or common law partners, especially when one partner's income is lower or they don't have enough taxable income to fully utilize a particular credit. Wealthsimple Tax automatically identifies these opportunities and applies them in the most advantageous way. Spousal or common law partner amount. If one partner's net income is below a certain threshold, for 2024, it's $15,705. The higher income partner can claim a tax credit called the spouse or common law partner amount. This can significantly reduce the higher income partner's tax payable. Wealthsimple Tax will automatically calculate if this credit applies and transfer it to the eligible partner's return. Medical expenses. This is a big one for many couples. Instead of each claiming their own medical expenses separately, you can combine all eligible medical expenses for both you, your spouse, and even dependent children, and have the lower-income spouse claim them. Why the lower-income spouse? Because the medical expense tax credit has a threshold, you can only claim expenses that exceed a certain percentage of your net income, or a set dollar amount, whichever is less. By pooling expenses and claiming them on the lower income return, you are more likely to surpass this threshold and maximize the credit. Wealthsimple Tax automatically pools and allocates these expenses to the partner who will benefit most. Charitable donations. Similar to medical expenses, you can combine all charitable donations made by both partners and claim them on one return. Again, the higher income earner often benefits more from this due to the way the donation tax credit is structured, particularly for larger donations. Wealthsimple Tax will analyze both returns and optimize the claiming of these donations for maximum benefit. Tuition and education amounts. If one partner attended post-secondary education and has unused tuition or education amounts, these can often be transferred to their spouse or common law partner. This is particularly useful if the student doesn't have enough taxable income to utilize the full credit themselves. Wealthsimple Tax will identify and transfer these amounts. Disability tax credit. If a person with an impairment doesn't need the entire disability tax credit amount to reduce their income tax, the remaining portion can be transferred to a supporting family member, including a spouse or common law partner. Pension income amount. For retired couples, eligible pension income can often be split between spouses. This is a powerful income splitting strategy that can significantly reduce the overall tax burden if one partner is in a much higher tax bracket than the other. Wealthsimple Tax excels at identifying and optimizing pension splitting opportunities. With that said, thanks for watching and until next time.